Not to be. Thanks, buddy. Did you get some sleep last night? Good, good. I'm going to expose the soft underbelly of this market. That's funny, Brent. Good afternoon. Welcome to Chicago Future of Finance, live from the Win in Las Vegas. It's nice to be here. It's a fun twist for a big day. It's Fed Day, obviously, and the Fed just cut rates. They're also going to be doing some QE. We're live from the Prosper Ultimate Trading Experience. Scott Bauer and the team been helping us cover this market as we ramp up, in addition to the Future of Finance contributors, Brent Kochuba and the Najarian bros. I think we've done a pretty good job outlining the trend and the general support for markets, which has been constructive. Price action led by big tech has been the story. We're from the Wynn Conference Center, so if you hear a little Christmas music in between the background or some Sinatra, the Bee Gees, I apologize in advance, but I'm kind of liking the vibes. You know, the music for the market, I think, goes quite beyond the Fed. Let's look at the charts here because I think they speak for themselves pretty well. You do have generally strength and technically in the S&P 500. This is the 10-year chart. which could get interesting because, as some have pointed out, I think I kind of did very originally, the bizarro relationship between the bond market and the Fed, which essentially began when the Fed embarked on its cutting program. We saw yields rise afterwards, and that to me is a symptom of what happens when you add support to an economy that's already generally pretty supported. We haven't had a lot of bad data. Maybe we haven't had great data, but overall, this has been an economy that's been pretty resilient. And so to add on a little bit of juice by giving the support from the Fed, then you're in pretty good shape to maybe see the economy stay strong, add a little cherry on top. I think that's the story. If that's the case, then look for the 10-year to break higher in yield. We're at 4.2%. You can see the line that I've had here basically for some time at 4.2%. Are we going to get a pop above there and make a big move technically? I mean, you can kind of see where this line has been important technical resistance for yield, which means support in price. But let's see if maybe we can push through that. I actually don't think this is the biggest story. Let's go to what the biggest story is, to be honest. And that to me is semiconductors. Here it is, 1.6% on the SMH. That's a good situation. You've got rallying prices in semiconductors and a trend that is unmistakable. Higher highs. Yesterday, Charlie Moon here at Prosper talked to us about Micron, another example of a stock breaking out and moving higher. The list is pretty long. First, it was Alphabet, which moved back in October and November. Then you saw Apple as well making a move. So all of this is very much, I think, in trend. And the other thing is that the weakness in crypto hasn't phased the market for stocks at least, and it does look like Master down 2.5%, not a problem. Bitcoin slightly lower on the day, but also firming up. If you go intraday for BTC and gold, you'll see a little bit of firming here just in the last hour. Not a ton for coins, but I think one big story is in the Russell 2000. Look at the small caps. We talked about IWM as being a very key leader. A lot of people looking for rotation, and it does seem like that's a pretty good place to look right now. And I do think that's a message that is oftentimes heralded, but never really followed through. And so now you actually get the follow through for the Russell and the breakout on the Russell and the small caps. That's a really good situation. I think that that's something that you can generally root for because it helps to have a leader in the market. And that's basically what you've got. To put some of this in context for the risk radar, the stocks will be going green here if we're making all-time highs, and I believe we are going to. Maybe Bitcoin will go yellow, bonds and the dollar. I'm still looking for more direction there. If the 10-year yield does go through 4.2%, you'll see bonds go red. And for the dollar, I just still don't see a lot of direction in that chart. As the dollar is getting hit today, generally you kind of assume that the rate cut will be bearish for the dollar, but let's see what happens. The bonds, again, I think this is very much a tech story. It's very much a flows story as well. That is really important. The flows that we've seen that have been consistent in the options market, the gamma pull, the drag of the overall bullishness and momentum, that is something Brent Kochuba has talked to us a lot about at SpotGamma. So let's get into it. He's joining me here back on the show. Brent, good to see you, sir, and good morning. Depending on where you are. It's noon for me out here in Vegas, which is kind of morning by Vegas standards.
I suppose it is.
Fed cut, Brent, is that a bonus, a cherry on top, a real important part of this narrative? Tell me how you're seeing today's action and fitting into the Fed narrative.
I think coming into this, it was a 90% odds that he was going to cut, so that the Fed was going to cut. So that seems to just have come to fruition. And obviously the guidance, the market likes the guidance out of this. And so that has allowed vol to sink. We see the VIX is now dropping down to about 15.5 right now. And that's helping the market to boost up into this 6,900 area. You were focusing a lot on semis before. So we clear the FOMC risk. As we talked about in our founders note this morning, we have this interesting situation where the Fed is clearing some risk today, but there is some event vol tied to events next week. We have CPI and non-farms payroll, for example, so there's an immediate attention sort of switch to that. Traders also are pricing in who the next Fed is likely to be, the chairman. So there's still some shifting around there, and so I think that the forward guidance for now is enough for the market to say, great. And then we're going to turn into, if you remember what happened around Thanksgiving, Oliver, we had the VIX around 25. It was a very tenuous situation. And then also when it happens, we hit the holiday, right? People go on Thanksgiving. And then you have a half day after Thanksgiving. And that was right after OPEX. And so all those puts, all those expensive calls when the VIX, expensive VIX calls that were in place around November options expiration and playing into the holiday, all that stuff got rolled out and eviscerated. Vol got smacked, and we rallied, right until Black Friday, right into that last week. And this is a little bit of a similar situation. Obviously, we're coming in with the VIX more at 16 here. But the key thing that I noted is that
sub 16 right now. I just pulled it up, Brent. We're at 15.6. The vol real crushed here.
Yeah, it's coming down sharply. So the Fed clears that out, and that's just allowing the market to rally. This is sort of a Vanna booster, right? Now, what's interesting about this is that you were touching on semis and the strength there, and I think Trump tried to fire up some animal spirits with news of NVIDIA, and maybe we'll sell some chips to China, and then China's like, maybe we don't want, and want them, and it's a whole saga there, right? But the big thing is we got Oracle tonight. Oracle has been the poster child for AI gone wrong. Everyone knows about their credit default swaps are surging in price, and we've talked about how when credit default swaps surge, what do? You buy equity puts, and that stock went from $345 down to about $200, right? Well, if you look at the positioning in Oracle now, another thing we covered in our Founders Note this morning, the positioning by hedge funds is short put, long call. That's how these traders are all positioned to Oracle. So people are actually leaning quite bullish into Oracle earnings tonight. There's a 9% implied move there. And so assuming Oracle just goes off that hitch, that's great for markets, and I think we'll continue to rally. You do want to sort of eyeball this, because if something kind of comes off awkward in that Oracle earnings report tonight, maybe that puts a little bit of a damper on this. Now, as soon as we report Oracle tonight, we go to Avgo tomorrow. Avgo is they're not explicitly in the Mag 7. Maybe they should be, because they are now a top 8 ranking in the S&P 500. So it's a big stock. It's a big deal in that semiconductor space. And so we have these two key earnings tonight. Then we'll go next week. We have VIX expiration. We have the CPI, NFP, which are generally not events, even though they're being priced a little bit of vol into that. You have OPEX, and then immediately after that, you go into Christmas, into the half day for Christmas Eve. Christmas Eve, full day, I can't remember. Anyways, most people go on half day mentally, at least. And then you got New Year's right after that. So you just sort of set up this situation where it's going to be painful to hold puts, right? And if you don't have an explicit reason to hedge something here, then you're probably not going to hedge in the end of the year. And then we get that kind of final Santa Claus push with giant open interest up around that 7,000 area. A lot of people are going to start talking about the JP Morgan collar trade at the end of this month, 12/30 expiration, which is in that same vicinity. So, that upside target, I think, is looming. Another thing just to note, even though vols are coming down, I was just checking the screens here, the 2025 delta calls, I was joking on Twitter saying I'm going to expose the soft underbelly of this market. If you look at next week's Monday, Tuesday, 2025 delta calls in the S&P 500, so roughly 7,000 strike. Those things are trading for about a 10% implied vol. That's about as cheap. You may get into the 8s occasionally, in S&P implied vol, but that's pretty dang cheap when you start seeing 10 and sniffing a little bit below. So that sneaky upside move with the clearing of, say, Oracle and Avgo, et cetera, that's totally in play right now, and I think people may underestimate the velocity at which this can jump. And the nice thing about that is maybe the market continues, maybe it doesn't, but if you're paying 10% implied vol for some S&P calls, that's pretty cheap. It's a pretty good risk reward, I think, to that upside. And again, I never know if you should go full bore in your portfolio long, but that soft underbelly seems to be that kind of 2025 delta call for next week, where that's only about 1.5% from this point, right, to continue that rally to the upside. So pretty cheap bet there.
Okay. I think opportunities, if you want to try and get directional when vol gets down here, kind of changes a little bit some of the opportunities when vol gets crushed like this, right? Maybe not the worst idea to own a little bit of premium if you've got a strong view on direction.
Yeah, and especially at those prices, risk reward is always about what are you paying for, right? If you think the market's going to go up 1%, sounds like a great idea. Well, what does it cost me to bet that, right? And if you're going to tell me that 10% implied vol for the S&P for those calls, I think that's a pretty good idea. In our Founders Note, we were pitching some call flies into 12/16 expiration, the 7,000, 7,100, 7,200 call fly. I think that's looking pretty good at the moment. And so, very cheap to bet on this upside. into these clearing events. And again, it's the vol contraction that is enough to move the market up. I'm not a macro guy, so I don't know if the Fed was super dovish here or not. Market seems to like it, but it's allowing vol to contract, and that is allowing the market to start to rally. Yeah, and that you look at gold right now. Gold's up about 0.5%, so that seems to like. I mean, assets just generally seem to be rallying here. So again, no reason to fight this, and it's cheap to play that upside. As far as looking at these earnings again too, some of these names, single stocks, also have very cheap implied vol. You look at Apple, for example, very low implied vols at the moment. So there's a couple of really cheap ways to get that upside optionality right now. And I think that's great because you can forego getting stock exposure and just get into the options at pretty impressive prices, or in terms of how cheap they are, and that's great. It's great risk reward, right? Because if you happen to be wrong, well, if you lose on an option buying S&P at 10% vol, no big deal, right?
Yeah, we were just looking at the chart of the S&P ripping there, pushing towards 7,000. Since you mentioned stocks here, let's go into the tape. Yeah, oh, and IWM is cranking. We're in the tape here, Brent, as you mentioned. IWM right here, 1.7 million on the options. Gamma notional 2, everything big. It just seems like there's a real vortex of momentum right now being driven by options traders who are largely bullish.
100%. I think if you're trying to say, is this rally real, and you see the IWMs are up nearly 2% on 1.7 million in volume, IWMs typically don't trade quite that much in terms of volume, and we still got another 45 minutes left in session. So, that's an impressive amount of volume. It speaks to, some truth to this rally. Also picking up, you see silver, VIX doing about 1 million contracts. Let's not forget VIX expiration coming up on us here. So, there's a bunch of VIX, a lot of VIX activity is going to be feeding into that expiration next week. As this vol gets crushed, you may get a little bit of extra momentum because you have that expiration next week. So that can help to propel things to that upside. So right now, assuming Oracle doesn't spoil the party, it seems like the 7,000 area with that massive open interest is the next major stop for the S&P.
Okay, I mean, hey, I think this is all very much in line with what we've been talking about, Brent, for some time. I don't think this was rocket science to figure out that the Fed would have a nice little bonus on top of what was already a very compelling secular story of big tech and a healthy options trading and an economy healthy enough to support people who have been buying the upside and getting rewarded for buying the upside in companies that are, doing big things, basically, at the risk of oversimplifying. I don't think it's rocket science. I think that, trend is your friend, as they've been talking about here a lot. That's my baseline. When I talk to people, when I'm at a conference and we're talking about how do you view the market, I tell people, look, I'm a weatherman for markets, basically. And the number one input is just technicals, higher highs, and we never really got a downtrend in stocks. We got it in some of the crypto stuff, but the correlation broke with stocks, so it looked like we were destined for 7K.
Yeah, and to that point, there's been several times where the market had this chance this year in just recent months, right? Through October, after the Trump
Bears
tweet.
Never took it.
November, we had big breakdowns, and those were just small concentrations. And the moment was there to have a really big 5 to 10% drawdown, and I think that moment when you start staring down big expirations, big holidays, and end of year flows, it's a little tough for that opportunity now to start to get that downside momentum. On that chart there, when we look at that trace chart, this updates every 10 minutes. So you're seeing the latest in S&P 500 options positioning. And what you see there in that purple area, right, that is the resistance areas that we would look at right now. So you can see at 6950, that purple zone is where we're seeing resistance heat up. I think at 6900 for today, we're probably done for the moment, but we're going to very quickly turn to the Oracle earnings. Again, if those are non-events, if it's a meet to beat, then great. The market's just going to kind of chug on and keep doing what it's doing. And so that 6950 is that really short-term resistance, talking about today into tomorrow maybe. But again, 7,000, the size of the open interest at that strike is just massive. Also, people love big round numbers, and so that becomes the big attractor.
Okay, so it seems like you get through these levels, then maybe we even have a kind of chase situation, because technically we haven't. To my point about trend, we haven't put in the higher highs. For the record, for S&P, we put the higher high in compared to November, but it's the IWM that's putting in the kind of breakout type stuff. So with vol getting crushed, it seems like the message is if you're following what's happening in the other charts for the Russell or tech, then upside calls maybe are affordable here.
Yeah, and you to the point on the soft underbelly, right? The 10% implied vol, and that stuff can get kind of jumpy if the market in this situation that vol gets crushed and things really start to move up. So you can have a little bit of a feedback loop where you get negative gamma to the upside because people start to buy those calls and they start to chase that upside. And I don't think dealers have a real short gamma position in a material way until maybe over 7,000. I mean, if you look at that chart, there's a small shade of blue there, but if you notice that after 4 o'clock, that shade goes away, which tells us that positive gamma, that resistance, is being supplied by zero DTE options. So there is not this construct where there's a ton of negative gamma to the upside until you really get up over maybe 7,000 kind of off the top of that screen. And that's so if you're going to say, when does the options market start to push back on this? The answer is maybe 70, 50, something up in that neighborhood. Now, as you rally, the market's going to react to that and positions are going to change. And so you're trying to forecast how positions will change. But for the moment, back to that soft underbelly tweet, 10% implied vols for next week's expirations, midweek expirations is again about as cheap as you can get. And so when we're looking at equity correlations, those aren't that low at the moment. So we're not in the situation where you're saying the vol is so cheap that it's a risk, because we saw some of those situations in October, for example, where equities were getting well over their skis in terms of call prices, single stock call prices. We're not seeing this, we're not seeing that situation at the moment. I do think that you could have a moment where Oracle goes off without a hitch, Avgo goes off without a hitch, we get a year-end chase, and then maybe you got to start thinking about, okay, semis rally another 3% at the end of the year, something crazy. Then you start January with maybe a risky situation. But again, over the next 2 weeks, if you want to buy a put and pay a lot of holiday decay, it doesn't seem terribly advantageous.
Yeah, I'm not familiar with that song. I'm hearing a lot of Christmas songs here, but I haven't heard the Holiday Decay. I don't think that's one I
Neither of
particularly
us are
want.
making as much money as Mariah Carey this season, I can tell you that.
That's not a tune I want to sing. Yeah, she's got a residency out here, I believe. Okay, so look, I mean, it seems like it's generally all signs go right now for Brent, long story short. And it's not like a complacent, dangerous, the ball is out of whack and, it's tender for a fire at some point. It seems like it's pretty steady as it goes.
Yeah, I feel like if anything, the risk here is that people are maybe starting to worry about the right tail a little bit now. And again, when you look at like the core 1M, the SIBO correlation index, for example, we have very clear levels at which you start saying, okay, this is getting a bit crazy, but we really haven't, hit that moment yet. IWs are starting to break out. You're starting to get Tesla now over 450, right? So we're at 455 there. We mentioned Google before is at 319. So, these leaders aren't, maybe except for Apple, these leaders are not breaking out to new all-time highs yet, right? So those are, if anything, maybe you could argue a little bit behind that kind of mag index. And again, the vols aren't the single stock vols aren't really necessarily bid at the moment, and the S&P vol is pretty cheap. So the risk reward there again is just, I think, very comfortable, where you can say I can get long these very cheap calls, and if I'm wrong, okay, I lost money on these cheap calls, like no big deal. But again, the risk reward, if you do get this kind of jumpy move, and I don't think the market is pricing that in, right? When you're talking 10% implied vol, it's not really pricing in a quick 1 to 1.5% move over the next couple of days. It just seems to be a bit underappreciated, maybe.
Yeah, I love that. Great message. Brent, thank you very much. As always,
Absolutely.
very helpful, sir. Great stuff from Brent Kochuba. And good analysis running up into this, too, about the market being ready for this type of move. I will take a short break. We got Jon Najarian standing by. His stocks looking pretty good. I mean, the Russell is really ripping here. Now we got a short break. Innovator Buffer. We'll be right back from Vegas.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction. With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Yo, Mr. Jon Najarian. We got a market here looking pretty good, sir. And I'm liking being in Vegas for a nice little market pop. Might have to put some of the Powell juice to work. How you doing, Dr. J?
Well, my man, it certainly is an interesting day. And the fact that we've got the most dissenters in the Fed in at least a decade, maybe several decades, is, I think, noteworthy because I think, and I've said it to you before, that I believe the Fed Chairman Powell had been playing politics and he wasn't data dependent as they always say they are. He just wanted to fight with the president. He didn't want to step aside and have somebody else come in. And now his legacy is going to be he's been late to everything. So don't invite him to any of your poker games out there, Oliver, because he'll be late to that.
Hey, we got stocks at all-time highs, pretty much. You know, the economy is hanging in there. It's pretty bustling here from Monday and Tuesday. They got the rodeo going on in Vegas, John, by the way, which is a new thing for me. I don't know. You ever been to a rodeo?
Oh yeah, and I've been to that one, and that one is the one of the biggest shows. I mean, I know the
Yeah.
AVN is something people talk about a lot, but I think the rodeo is actually one of their biggest, most fun shows that they do. Certainly, consumer electronics is a big one out in
Got a
Vegas,
big one. Yeah.
significant driver, and it usually coincides with the AVN.
Well, that's what I'm saying.
But
It's gammon out of here. So I don't know, Powell. I don't think I got to give him at least an A minus. You know, economy hanging
come
in.
on,
I don't know if we want to
well,
cook it too much.
No, you don't want to cook it too much, but what you're doing is you're going to see a pent up rally, I believe, because of what he's done. Because I believe that a lot of bad news is priced in. He would have had a mutiny had he not, or had he followed with, for instance, Austin always late Goolsby as well from the University of Chicago. The economic data has been soft. It has been soft, soft, soft. They've got every reason to cut rates. Our rates are higher. And, is your goal to bankrupt the country? You're talking about 37 trillion in debt. I mean, we're setting that function at, 4.2 this morning for the 10-year. Now it's come down, obviously. I think by the middle of next year, you'll be looking at 3.5, Oliver.
Okay. I mean, here's the only catch, John, is when they first started cutting, yield went up, and I thought that was kind of a sign that things were getting juiced up a little bit. People were like, "Oh, we're cutting. Why are rates going up?" And my point was, all right, well, if you cut when
They were
things are all
late to
right,
that
yields
because they were
rise.
late. Yeah, they were late to that cut. They waited way too long, kept him high for too long, just like he kept him low for too long. That's why I'm saying he's late. Doesn't matter if you're bullish or bearish. I mean, again, we can trade any market. You and I and the guests you have on here, we can trade any market. But clearly, they were really late on how long they kept rates at zero. And that's why we had that spark of inflation as well as the Inflation Reduction Act. And then we had a lot of quantitative tightening. Now we're at quantitative easing. So this is why I'm looking for like a lot more than 7,000. I think we could hit 7,300 even as this quantitative tightening ends. And the ISM's been under 50 for 3 years. I mean,
Hmm.
how much softness do you need to see?
Manufacturing, yeah, yeah.
Yeah.
John, when you look at 73 as a potential, Brent and I were looking at vol crush today. VIX really getting slammed. One of the things it seems like is encouraging is it doesn't look super expensive if you do want to buy some calls to the upside, if you do want to take a directional bias. I mean, this doesn't seem like a very complicated situation right now. It'd be one thing if we were ramping up and vol were rising too, and we had one of those stocks of vol up situations. But I don't know, this kind of seems like a vanilla way opportunity right now to kind of ride the wave if you're seeing vol as cheap as it is.
Yeah, fall back down into the 15s. You're going to have, Oliver, I'll throw a couple ideas out to you. Performance
Hmm.
chasing. You and I have talked about that in the past, but when you've got 78% of the funds right now trailing their benchmark, you're going to have to chase into year end if you want to hold on to some of that AUM, assets under management, of course. And the equities got oversold in November. We bounced, but they got close to those April lows, even in November, because again, we've been making these baby steps on interest rates, which I think was the wrong move, unless they made multiples in a row, and he was against doing that. And then you've got seasonality, Oliver. December usually finishes strong. So if you
Yeah.
take funds chasing, equities oversold, and seasonality, I think you're setting up for 7,150 to 7,300 out of the S&P here.
Yeah. All right. Hey, I love that. Sounds like a good message to me. What
I
about the
think a
small
lot of
caps,
people will like it.
IWM, John?
And that'll be despite the Fed.
Right.
And, keep in mind that if they go slow, 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 which they've been doing, you could have a shadow Fed start coming in there. I mean, he's going to be talking to Warsh. He's going to be talking to all these potential Fed chairmen, and they will be saying what they think of this sitting Fed chairman. And it's like, do you really want? So you're the coach that says you're going to leave whatever team it is, in this case, Mississippi, because Ole Miss lost their coach. So what if he was stuck there and then everybody second guesses all of his moves? And they said, well, he's obviously not going to be able to win the national title now because look, all these players are transferring. Look, the interest rates are too high.
Yeah, yeah,
I
no,
mean, all of that kind of stuff. I don't
you know
think
what?
his ego can stand being second guessed for the next 5 months because he's in the seat until May. I
Yeah.
don't know if they try to hold back the cuts that we need. I think you'll see a bit of a mutiny, and I think you'll see the Fed chairman embarrassed even more so. And he's looking pretty tired. When you see him right now, he looks like a guy that's been president for 8 years rather than a guy who's been in his seat for eight.
Hey, I respect the view. I don't disagree that maybe there could have been some better, finer tuning on their timing. I'm not as big of a critic of Powell. I think the Occam's razor sort of simplest explanation is that the economy's been strong, stocks have been strong, the rodeo's got full attendance. It could be a lot worse. But to your point, John, there's someone new coming, and there's no question about it. So let's look at the Kalshi numbers. Okay, let's put some money where we're talking. Right now, Hassett 71%, Warsh 14, Waller 7. Tell me what you want to buy. Tell me what you want to sell here, John, for the Fed chair.
Well, I mean, I think it's Hassett's to lose. The Kelshi numbers are telling us that the people that I hear from in the Beltway say the same thing, except only higher. Um, Now, that's not to put down Kevin Warsh. I think he and Waller certainly strong candidates. Gosh, I mean, the strongest of all is number what, four on your list, Percent, but I don't think he wants to leave Treasury. Um,
Yeah.
if 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 Trump got an inkling that he wanted to leave Treasury, you could even swap those two, Hassett for Bissent, because Bissent seems to be doing just a fabulous job. But based on what we're hearing, both of us, as well as this betting, seems like it's Kevin Hassett's to lose.
You buy Kevin Hassett at 70%, looking for 29 on 71.
Yes, sir. Yep. I think it's not a 50% return, but it would be a pretty strong return on your, if it's $70 or if it's $700 or $7,000. Getting 30 uh, cents back on every dollar that you bet seems like a pretty good bet for, like I say, somebody who has been vetted pretty strongly. We all know that, you still would have to be sitting before the Senate. But I think this guy would be able to qualify.
And for a 6 month play, by the way. So that's pretty good return on investment there. 30 on 70,
Yeah,
roughly.
annualize it, and you're at almost 100%. You're at 80% return
Yeah.
if indeed it is Kevin Hassett.
So that's, I think, an interesting one on Kalshi right now. 30 on 70 is nice. Like that trade. The other thing I was going to say, John, is if
Yes,
you
sir.
look at the odds for cuts, I was watching CNBC earlier and they were talking about how the odds for a cut in May to June make a pretty big jump. But the thing I thought they kind of overlooked is the fact that there's just sort of a linear relationship with time right now, where the further out you go, the more odds there are for cuts. Now, I get the Powell in late spring is going to, be out. So maybe that adds a little bit of dovish kind of tilt on. But I still generally think that that's kind of telling us that linear relationship between time and the odds of cuts, that whoever's in charge is generally going to have a dovish bias. I feel like for the most part, for me, John, I just feel like the tech stuff, the Micron trades, the AI stuff, Tesla firming up, all those are more important, I think, frankly, to the market and what this has been about, this bull run in tech, than the Fed. What do you say to that?
Absolutely right. You're
You
absolutely
agree?
right. I mean, yeah, whether it's Ms. Sue
It's a bonus.
over at AMD, or whether it's Jensen Huang over at NVIDIA. I mean, the numbers that they're putting out are extraordinary. Now, as your last guest said, we're all waiting for Oracle tonight. Oracle should be putting up some pretty interesting numbers as well. And I don't really think it's in the cards at all for the the firm, for Oracle, to say anything but positive things about demand, about where they see data centers playing out here. And I think if indeed they get to go back and forth with questions, it'll probably be about their spend, because the spend is going to be dramatic. From what we've seen so far, we think we're going to see pretty dramatic spending out of the Fed, basic. No, I'm sorry, not the Fed. Out of Oracle here to meet the demand, and that's not a bad thing, but that's something that you could poke at perhaps, because I think people will be interested to note exactly what goes on with Oracle's spend, because that 35% rally after the last earnings report in August was phenomenal. Made Larry Ellison briefly the richest man on earth,
Mm-hmm.
but the basically, I think free cash capex is supposed to be right around $35 billion for fiscal year 2026. That's up 65%. So if you want to poke at something, that'll be what the analysts might poke at. But it just depends on how good the revenue is and how good the projections are for the backlog, if you will, the RPO.
I'm looking at also another bet here on Kalshi. Who will be the top three wealthiest people in the world? Elon back at 99 as we close out the year here. But to your point, Larry Ellison did leapfrog for a moment in time, 86%. JB, Mr. Bezos, and the Zuck right behind. I don't know. It feels like maybe not enough love for Meta in there, but
Oh,
obviously the
I
stock
got
has been
lots of
quite a bit
love for
weaker.
Meta. I got lots of love for Meta, but I don't see
Yeah,
him pulling $1.5 trillion out of his backside.
yeah,
You just
and the
saw
stock's
Musk
hurting.
pull. Yeah, you just saw Musk pull $1.5 trillion out of his backside through SpaceX. The latest funding for
True.
SpaceX before they go public, and I don't know, of course, maybe they'll do another round before they go, but the latest round has their valuation at $1.5 trillion. Nobody else in the history of man has ever come close to that for a privately held company before they go public. It'll be the biggest IPO of all time, assuming that they can hold something like that. And why not? I think you said this recently, Oliver, that he puts up 94% of the load into space through SpaceX. And that's, of course, not even taking into account the money he makes from Starlink, which is obviously under the SpaceX umbrella. So, yeah, if somebody wants to catch Musk, he doesn't need the trillion that he's going to ultimately get from Tesla to be the richest man on earth. He just pulled another $1.5 trillion out of his backside.
Yeah. I think my tweet of the day. Where'd it go? Oh, there it is. Yeah, Ben Carlson. Let me pull it up real quick. This is
All right.
relevant to the conversation. My tweet of the day here. You're gonna like this one. Ben Carlson, wealth of common sense. The meme of De Niro looking at you, and he says, "We're gonna do data centers in space, and you're bearish." But hey,
Yeah.
it's true. Yeah.
Right. And you know who was the main proponent of putting those data centers in space is Google. But Google doesn't have their own rocket, do they? So guess who's
Right.
taking those? Yeah, exactly. They're coming over to Elon. And obviously in space, you don't have to worry about cooling it. And you know what else? Solar runs 24/7. Doesn't run 24/7 on Earth. It runs 24/7 in space, those data centers. So I think you're going to see an awful lot and hear an awful lot about space-based data centers, Oliver.
True. Um, I was trying to figure out which De Niro clip this is from. It's Joker, his brief role in the Joker before
Oh,
Joaquin
yeah,
Phoenix
when
did
he's
him
the
in.
talk show host.
Yeah, exactly. But it looks so
Yeah,
much also like the look, he gives when he takes the drag on the cigarette in
yep.
Goodfellas too, right before they whack Marty or whatever his name is. Marty, I forget. Sunshine I Love playing in the background. John, you the man. Thanks as always, sir. Appreciate it very much for your time. Jon
Always
Najarian,
appreciate being on with you, Oliver. Keep fighting the
thank you,
good fight,
sir.
my man.
Love that very much. Thank you, Jon Najarian. And Pete, yesterday I had some audio issues, but I know you guys couldn't hear John. That was on me. So glad we got you here from Vegas. All right, taking a short little break here, and then we're coming back. Scott Bauer going to join me as we are going to take this market into the closing bell.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. SIBO is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress
You've been able to
for the
hear me?
self-made trader,
Yeah.
and the only still standing in
There we go.
America.
Okay, got it.
The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from SIBO, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% trap? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction. With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% trap? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, welcome back. We're here at the Prosper Ultimate Trading Experience with Mr. Scott Bauer in Las Vegas. It does look like, Scott, we've got a pretty decent little market here with the small caps kind of ramping up. So I think we start there, right? Because we're looking for basically, we've been talking 7,000 with Brent Kochuba, 7,300 for S&Ps with John. But the story right now is kind of the smalls.
It for sure is. I think we talked about this the other day. This is going to be the leader to new highs for everything going into the year. And if this really continues this rally, then this is serious. If the small caps are going to lead us through, if the small cap space really believes that what Powell said today is, let's call it not best case scenario, but I'm going to call it not worst case scenario. This is really bullish for the market.
The chart looks pretty good. I mean, the breakout is no joke. Looking generally at the Russell firstly, we've got first a big move after consolidation at the old 2,500. This is the group that oftentimes kind of moves the slowest, disappoints the most often.
You got it.
So to me, this is a pretty good sign that we're in pretty good shape.
It's a really good sign. And if you look at the chart there where we stalled, right? That stall was right at the previous highs there, right? Where there was major resistance there. And then we just broke. But you're right. This one lags. But it tends to also follow up and pick up and catch up the quickest.
When it does hit, it hits real nice.
When it does, it hits really nice. And again, for those that don't know, the small caps really benefit from a lower interest rate environment. And as much as I thought that as many people that this was going to be the hawkish cut, right? We've heard a lot about that. Powell didn't really come off that way.
Yeah, no hawkish cut today.
And the other thing also, there was talk that there were going to be as many as 4 or 5 dissenters for a cut today, and there were only 2. So I think the market is looking at this as pretty bullish here. Even though they said, maybe, or the dot plots are saying maybe 1 or 2 only for 2026. So I think this is really bullish. I'm not saying that this is your Santa Claus rally. Maybe it is. Maybe we get I wouldn't be surprised to see a pullback from here and then into year end, get back to where we are now, or maybe, just all-time highs. I think the move today is I'm going to call it a little bit too optimistic for the short term. When I say short term, I'm talking over the next few days, maybe into next week. But I do think this sets up a really nice narrative, a really nice base going into the end of the year.
Bonds firming. The 10-year chart is pretty interesting. I'll pull that up here, 4.2. I do think that this has been low ranking in my analysis, at least, because there just hasn't been a lot of direction for bonds in the dollar. You've kind of had this range essentially between 4 and 4.2. This is a line that I've had for some time. And you can see where it was support for yield in the past, resistance for price. It would be interesting if we break through that to the upside in yield.
Yes.
It would be also interesting if we got rejected and bonds rallied again, but I think a little bit less interesting. How are you thinking about this part?
Yeah, I agree with you. I think the concern for the marketplace here is that we do break through there. And there's nothing magical about 450, except for it's one of those big round numbers that over the last several years, 4.5%. has been kind of that line in the sand where the market's gotten nervous. So if we do break through this here, maybe we don't see the equity market, sell off a lot, but if we get to 4.5, Oliver, that to me is going to set some panic in.
Might be a little bit discomfort.
A little bit of discomfort here, but that range that you pointed out there, 4 to 420. I mean, boy, if you're trading bonds back and forth here, that is a range. We are going to break out on one side or the other here. Personally, I hope we see the bonds rally and yields come down here. I actually think we're going to tick up a little bit higher in yields.
Okay, so maybe a little short bond,
action. Look what the rest of the world's doing, right? I mean, look at Japan, look at Germany, look at everywhere else. Especially when you look to the long end of that curve there, it's kind of tough for us to be cutting or seeing the long end of our curve come down when the long end of the rest of the world, or at least the other places that people are, looking at bond markets, when those rates are going up.
Last point real quick, because I got to jump. You're super busy here at the conference. This has been a really fun meetup.
We appreciate you being here. Love your participation.
For sure. Vegas has been jamming too, which seems good for the economy.
Yep.
Any 1 minute takeaway about what you guys are doing here? By the way, it's not a requirement at this event to wear dark on dark. It just so happened that we both did it today.
No, we did.
Rodeo.
That's right. We did not call each other this morning. Yeah. No. What are we doing here? This is an opportunity for our students and some of the people that follow us to actually get here in person and meet myself, meet the other great educators, traders here, and work one-on-one. And then listen to people like you who have, just all this wealth of information, because we're online every day. We're live with our students, but to get the, in-person interaction, so many of us over the last several years missed that. Have lost that.
Yeah.
Right.
Yep.
And there's nothing like being in person. And I know, this is the first time we've done one here. We do them in Chicago all the time. This is the first time we've done it here. It won't be the last, because it's been a great several years.
It's been a lot of fun. I think a lot of the prospect people, your clients, are very solid options, traders, and I've been impressed by. And so it makes the conversation and it makes the analysis that we've been doing, I think, really brings something to the table, especially for some of the more complex ideas. To sit down and kind of walk through them and talk about them.
Absolutely. We talk about the, just basic options all the way up to, pretty intricate
There are some
types of
people doing zero
strategies.
DTEs, slinging stuff. I know Charlie's got a room for that as well,
right.
which I like. That's kind of, I think, a really important part of this market.
Yes.
Scott, good event.
Thank you again. I really appreciate it.
For sure. Let's get back to it. We're here in Vegas. Closing thought. Here's the going to the bell. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% trap? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, quick closing thought here as we go into the closing bell. We got 2 minutes. And again, the story of the session is the Russell 2000. We got futures M2K hitting 2560. Small caps are not to be messed with. A nice rotation. People were looking for leadership that's a little bit different in nature, but certainly works, and one that is not to be disappointed in or shied away from. There's been a lot of fits and starts, and false starts in particular for small caps. But then to see right now that leadership show up at a key juncture here does suggest a good bit of optimism flowing into the equity market. S&P 500, great point from Brent that it looks like it's cheap to buy upside with VIX getting crushed. That's a big story today. Volatility, look at the candle for VIX down to 16 and below. That's a big deal. Obviously, we haven't spent much time below 15.5. You usually don't, especially if you zoom out. Look at the past year. Opportunities where VIX falls below 15 are very few and far between. Usually, the income approach using options and having a balance rather than just owning premium and the risk of time decay right now, it's pretty cheap to take that risk. So if you have a strong view directionally, whether it's up or down, using options to speculate is a pretty cheap opportunity when VIX is where it's at. If it goes even cheaper, then fire away. BTC sitting at 92.5 right now is pretty weak, but I still think looks like it should revisit 100K. Question is if master will follow, and if you get that big kind of crypto risk on vortex, how important is the Fed cut for crypto? BTC, I think it seems very reasonable to go and test 100K at least. Lastly, just one look at the risk radar, because I do want to iterate that yellow light for stocks is itching to go green. Let's just get through 7,000. We're so close for the S&P 500. Very, very close. Have a great day. I'll see you on Friday. Traveling tomorrow. I'll be back at SIBO floor Friday from Chicago. Have a great night.